In case you are unfamiliar with the term, counterparty risk refers to the risk of another party failing to fulfill their fiduciary obligations. Here's a breakdown that makes things a bit clearer. In order for a transaction to take place, there must be a buyer and seller. As a result, there are counterparties. It is the responsibility of each party to fulfill its obligations. It's the seller's responsibility to provide the product being sold and the buyer's responsibility to provide the funds for the purchase. It is always possible for one of those fail. Risk associated with counterparties are known as counterparty risk. Investing in gold and silver coins or bullion can potentially reduce that risk as part of your portfolio. It seems appropriate at this time to explore this topic in greater detail and highlight some of the different ways individuals can invest and store their gold and silver while highlighting the counterparty risk associated with each option. Gold and silver ETFs. Exchange-traded funds, ETFs, are one of the most popular ways to invest in gold and silver. There are a number of gold and silver ETFs available in the marketplace, but GLD and SLV are the most popular. Trading in these investments happen over the counter, OTC, rather than on a traditional stock exchange. These derivative contracts are proxies for gold and silver markets, since their value derives from the underlying commodities. Now, this is an inexpensive way to invest in silver and gold, but it is subject to counterparty risk, which we will discuss in further detail. On to counterparty risk of gold and silver ETFs. There is no physical gold or silver in the fund that you own. There are many ETFs that are highly leveraged and aren't fully backed by precious metals. Recently, it was revealed that 50% less silver is eligible and available for physical delivery than originally believed. Investing in gold and silver ETFs is merely a proxy for physical investment. Physical gold and silver prices aren't necessarily reflected in them. A gold or silver ETF could become worthless, but physical gold or silver never will. Gold and silver mutual funds. A gold and silver mutual fund is also a popular way to invest in gold and silver. In general, mutual funds invest in underlying stocks and or track an index. An example of a mutual fund you might be familiar with is the Vanguard S&P 500 mutual fund, which tracks the performance of the S&P 500 index. The majority of mutual funds have exposure to mining stocks, but for the purposes of our discussion, we'll focus on those with significant investments in physical gold and silver. The counterparty risk associated with mutual funds are similar to those associated with ETFs. Now on to the counterparty risk of gold and silver mutual funds. As with gold and silver ETFs, you don't own the underlying metals. Rather, you will receive the dollar equivalent of your purchase when the fund is liquidated. There may be an opportunity for misapportion of the funds in between audits, as many of these funds are only audited once a year by third-party auditors. Mutual funds also face reputational risk in addition to counterparty risk. If the company is alleged to engage in unethical business practices, it might seem mass redemptions, which it might not be able to meet once again, leaving you empty-handed. Gold and silver mining companies. A popular indirect way to invest in gold and silver is to invest in gold and silver mining companies. In the marketplace, there are plenty of gold and silver miners. Investing in gold and silver mining sectors through indexes is a popular option. The most popular gold miner ETFs are GDX and GDXJ, and the most popular silver ETF miners are SIL and SILJ. Risk-averse investors should not invest in gold and silver mining companies or ETFs that represent the mining industry. It is important to note that these investments can have dramatic daily swings, making them some of the most volatile. The volatility is similar to that of cryptocurrencies. It is true that gold and silver miners can offer tremendous upside potential, especially in a bull market, but they have also experienced devastating losses, especially junior miners that are more volatile than larger mines. In this video, we're not focusing on volatility, so we'll only address the counterparty risk related to this sector. Now onto the counterparty risk of gold and silver mining companies. Many mining companies have exposure outside of the United States, which poses a counterparty risk. The concept of country risk refers to the uncertainty associated with investing in a particular country, and more specifically, the extent to which that uncertainty may cause investors to lose money. The government could also nationalize or seize the company or mine due to geopolitical risk. Several mines have been forced to close during periods of war, civil unrest, and rioting, particularly in third world countries. Unexpected strikes can also result in a temporary shutdown until the parties regroup and reconcile. Safe deposit boxes. When it comes to storing gold and silver, safe deposit box may seem like a great option. It is unlikely that many people have the ability to break into a bank vault, drill out the safe deposit boxes, and steal your valuables. Now, we have seen plenty of movies dramatizing these events, but the reality is that it is rarely, if ever, happens. Many people in our society have used safe deposit boxes for decades. The safe deposit box was perceived as the safest place to keep all my parents' valuables documents according to this belief. It was nearly impervious. Safe deposit boxes. When it comes to storing gold and silver, safe deposit boxes seem like a great option. It is unlikely that many people have the ability to break into a bank vault, drill out the safe deposit boxes, and steal your valuables. We've seen plenty of movies dramatizing these events, but the reality is that it is rarely, if ever, happens. Many people in our society have used safe deposit boxes for decades. How could this option have counterparty risk? In spite of what you have imagined, there are a few risks to be aware of. Now on to the counterparty risk of safe deposit boxes. Now, it is possible for the bank to change its safe deposit policy. Some banks no longer permit the storage of precious metals or cash in safe deposit boxes. There is a possibility that the safe deposit boxes may be opened by natural disasters. An expert in safe deposit boxes was once instructed to drill out depositors' safe deposit boxes in New Orleans after the flooding and hurricane damage from Hurricane Katrina. As we saw during the financial crisis in 2008, the bank could go bankrupt. Safe deposit boxes may not be used in the same way under new ownership. Your safe deposit box is only accessible to a limited number of people. A natural disaster, a banking crisis, a pandemic, capital controls, etc., can all limit your ability to access your safe deposit box, during which you may require immediate access for liquidity purposes. Private depositories. As a result of some of the issues that we have gone over so far in this video, private depositories seem like a great option. These depositories, in theory, give you access to your gold and silver 24/7, and they aren't influenced by the banking system, and they aren't directly influenced by government policy, such as the passage of Executive Order 6102 that made gold ownership illegal for U.S. citizens. With private depositories, there is still exposure even though many of these points are valid. Feds raided a Beverly Hills depository in March of 2021, as many of you have heard. There were allegations that vault owners and vault holders were involved in illicit activities, and the FBI seized the assets of all 369 safe deposit boxes. Despite the fact that the majority of depositors had nothing to do with the illegal activities, in many cases they were required to provide evidence that the assets were legally acquired. Other cases were settled out of court to avoid unnecessary time, expense, and embarrassment for safe deposit box holders. This option has given us one of the largest counterparty exposures, but there are still others, of course. On to the counterparty risk of private depositories. A potential risk is illegal dealing by the owners of the depository could result in your assets being seized. In addition to seizure by government officials, bad actors may gain access to safe deposit boxes of customers suspected of having valuables. It is possible for the owner of a private depository to be ordered by the government to limit or prevent access to the depository. When you hold gold and silver in the palm of your hand, there are no counterparty risks. You are the only party involved if you own physical gold or silver. The absence of a counterparty means the absence of a counterparty risk. There are no people or institutions that give precious metals value. There is nothing that can prevent gold and silver from losing their value. In a nutshell, gold and silver are liquid under all market conditions. Silver and gold are tangible assets that you can hold in your hand all over the world. They can be bought and sold. Globally, they are recognized for their value. The price of gold or silver may fall, but it will never reach zero. Precious metals can't default on their payments. They can't commit fraud, and they cannot go bankrupt.